and I'm a member of the Brigham Young University Morgan Externship. Today I will be presenting our proposed allocation for a $100 million investment portfolio. To begin the presentation, I'd like to ask the question, why should you invest in hedge funds? The simple answer is volatility. In a sideways market like we've been experiencing most recently, volatility is the risk you have of losing your money in the market. The purpose of hedge funds is to minimize this downside risk. In order to consistently outperform the market, it is important to weather volatility in stable investments like hedge funds. In addition, hedge funds enjoy less government oversight and therefore offer more freedom to pursue whatever strategy will yield the best results for the investor. And now, more recently, with hedge fund indexes like those offered by HFRI, individual investors can now access the protection of hedge funds even if they do not have millions of dollars to invest. To minimize risk or volatility, diversification is also essential for any portfolio. The way we achieve diversification is through the efficient frontier model. The efficient frontier modeling allows you to mix and match combinations of thousands of potential portfolios. Our particular model analyzes 20,000 potential portfolios using 20 years of historical data, and then calculates the risk and return relationship for each of these portfolios. On the next slide, you can see a graphical representation of this efficient frontier model. Each point on the graph represents one of the 20,000 portfolios. The line tangent to these portfolios and the point where they intersect represents the optimal risk-return relationship. The point to the left is the portfolio allocation that we have chosen. The reason we have chosen this point as opposed to that optimal risk-return relationship point where the line intersects is that we believe the market will react differently going forward than it has in the last 20 years. In short, we believe the market will be more volatile. That's why we've picked a point with a similar return prospect, but with a much decreased exposure to volatility. And that can be seen on the X and Y axis. It has a similar value for expected returns and a much decreased volatility measure. The specific allocation that we have chosen is as follows: 33% fund of funds diversified, 26% weighted composite index, 25% macro, 9% event driven, with 7% split between equity hedge and relative value. HFRI Fund of Funds Diversified Index supports the largest allocation. While providing added diversification, it maintains a low volatility of 6.11%, while only capturing 11.54% of the market's down capture. Similarly, HFRI Fund Weighted Composite Index also enjoys increased diversification with over 2,000 single manager funds and global equity exposure. However, it captures 20.97% of the market's down capture. Its low volatility and superior returns per unit of downside risk, as evidenced by its competitively high Sortino ratio, make it an attractive choice. Both of these hedge fund strategies have high exposure to equity markets. You might be asking, in this volatile market, why do you want exposure to equity markets? Surprisingly, strong U.S. data suggests a rebound is not completely out of the question within our 2 to 5 year investment horizon. As we are in a depressed market with prices at relatively low levels, you want exposure to potential upswings while hedging yourself against volatility. In contrast, the HFRI Macro Total Index is relatively high as well because it actually averages positive returns in weak markets. So you have roughly 2/3 of the portfolio poised to take advantage of an upswing in the equity markets, with a full 1/3 of the portfolio hedged and poised to take advantage of a downswing in the market. And always remembering that all 6 hedge fund strategies minimize downside risk and hedge against volatility. On the next slide, you can see the performance of our proposed portfolio over the last 20 years. The optimized portfolio has historically outperformed the S&P 500 by nearly a factor of 2. The portfolio has 1/3 the volatility of the S&P 500. Historically, the portfolio only captures 32.23% of the market's up capture. However, this is outweighed by the fact that it only captures 11.54% of the market's down capture. The portfolio earns more than 6 times the market per unit of risk in comparing the Sharpe ratios. Similar results are found in Sortino ratio, earning more than 7 times the market per unit of downside risk. A relatively low beta of 0.25 signifies an investment with a volatility considerably less than the market, and also with returns that will not simply move with a volatile market. Another way of saying this is a low correlation. Also, a modest alpha indicates superior returns can be expected above the return of the market. Or another way of saying this is returns not explained by the portfolio's beta can be expected. In conclusion, we believe that a well-diversified hedge fund portfolio with a low risk profile with minimized exposure to downside risk is the best option in the current market environment. And we are confident that this strategy will achieve superior returns for your portfolio. I hope you've enjoyed this presentation. Thank you for your time.